So today we are going to learn about short straddle option strategy. In the previous class, we have learned about the long straddle option strategy. The long straddle strategy is used when the market is volatile. So when there is a volatility in the market, in that condition, we make the long straddle strategy. When the market is range bound or consolidated or sideways, then we should make short straddle strategy. It is just opposite to long straddle. Long straddle. The long straddle means when the market is volatile, and short straddle is opposite to that when the market is range bound with, and we believe that there would not be much movement in the market. So in the previous strategy, we have learned about we have made the long straddle strategy by buying the call option and the put option of the same strike price of the same expiry. Okay, and in that case, we need to pay the premium. But in the short straddle, what we do, we believe that the market is not going to break a certain level and market will remain up in a particular range. So what we do in case of, instead of buying the call option and put option, we do the opposite. We just sell the same strike price call option and the same strike price put option and receive the premium. Okay. So in this condition, in this example, we can see Nifty is trading around 4450 on 27th April. Okay. So what we do, we are selecting a strike price of 4500. Okay. And we are selling the call option and the put option as well. So we are selling the call option and receiving the premium of 122 point. Okay. At the same time, we are selling a put option as well. We are writing the put option as well and receiving the premium of 85 point. Okay. The total premium I'm receiving is 122 plus 85 is equal to 207 point. So we have received the total premium of 207 point, and that is my maximum profit. That will be my maximum profit. So if the market will remain in that particular bracket, in the bracket on the bracket of 200 point. Okay. So it just like the previous strategy. Okay. Or you can say that this is the strategy of a seller. Okay. A long straddle was the perspective of a buyer and this is the perspective of a seller. So as you know that we have the two break-even point, one on the upper side and one is the for the lower side. Or if you add the 200 point in the strike price we have chosen, so in this case we have choose the strike price of 4500 and we have received the premium of 207. So the upper side break-even point would be 4707. Okay. So if the market is not going to close above this level, we can make some kind of profit. Same way, if you minus 45, if you minus 200 point from 4500, you will receive this value. This is my break-even point on the lower side. So if the market will remain between these level, if the market would remain between this area, we could have make some profit. Okay. And if the market is going to break any side, then we'll start making the loss. If the market is going to close above this level, then we'll start making some loss. If the market is going to close below this level, then we will have some loss. Now let's check out the profit and loss table. So we have choose a strike price of 4500. Okay. And this is the put option, the premium received from this, and this is the call option premium we receive. So in case of, because we have write the call option, so if the market, if you see the individual break even point, so 4500, okay, 4500 we have choose the strike price and we have received the premium of 120. Okay, so it means that if the market is not going to close above 4500, we will make this profit. So you can see we have the constant profit of 122 point. Okay, if the market will close below this level. If the market is going upward direction, so in this case, here the intrinsic value would be 100 point, but just because of that, we have received the 120 point, still we are in a profit of 22 point. Here the intrinsic value would be 200 point. 200 point minus 122 equal to 78. Here there would be no break-even point. Okay, here you can see the loss is increasing. Okay, so here you can see there is a gap of 300 point, but we have received the premium of 122 point. So total loss would be 178 point. Okay, same way, total loss is 278 point. Total loss is 317 point. So this is the individual payoff. Same thing, if you sold this call option or put option of 4500, and if the market remain above this level, then you receive the premium of 85 point. Okay, but if the market is closing below your level, okay, then you'll start making unlimited loss. Okay, now you can see the market is going below your level and you start getting the loss. And because we have received only the 120 point to hedge, so it will protect you up to the 122 point. Okay, so if the market is going below my break even point, what is my lower side break even point, and this is my upper side break even point. This is my upper side break even point. Okay, so if the market remain in this bracket, then you can make, this is your total premium received. So if the market expire on this level, you will make complete profit. So you have received 207 point and your profit would be 200 point. Okay, if the market close at this level, then you have received the 200 point, but you have to pay the total profit would be 107 point. Okay, if the market is coming 100 point here, okay, so there would be the loss of 100 point, but we have received the premium of 200 point. To 200 point minus 100 point equal to 107 point. So still you are making a profit of 107 point. Here the intrinsic value is 200 point. Okay, but we have received the premium of 207. So still we are having a profit of 7 point. Same thing for this. Here there is a 0 break-even point. This is my break-even point on the lower side, and this is my break-even point on the upper side. So if the market remain in this bracket, this is my maximum profit. This is my maximum profit, and this is my minimum profit, and this is break-even point. So if the market remain in this area, we'll make at least something. Okay. If the market expire at the same level, so you'll make the maximum profit. But if the market is going to break, if the market is become volatile and it is break either side, then you have the unlimited loss. So if the market is going in the downward direction, you can see the call will only protect you up to 122 point. Okay, so if there is a loss of 200 point or 300 point, so it will only protect you up to 120 point. Okay, now you can see the market is going in the downward direction, we are having the unlimited loss. Okay, same thing if the market is going in the upward direction. Now again you can see, if the market is going upward direction, the put will protect you only up to the 85 point, because we have the insurance of 85 point only. This one. So we have received the 85 point. Along with that, we have received the 122 point. Okay, so this is my total premium. But at this level, after your break-even point, you can see if the market is 4800. Okay, now you have the loss of 300 point. Okay, but we have received the premium of 122 point. So 300 point minus 122 equal to 178. So we are having the loss of 178 point, but we have received the premium of 85 as well. So 178 minus 85 equal to 93. Still you are in a loss. Okay. So as you can see, the market is going to protect you only up to a certain level, because it can only protect you up to 85 point only, not more than 85 point in the upward direction, and it will protect you up to 120 point only, 122 point only in the downward direction. So okay, so we should only have to make this strategy if the market is range bound. So what we can do is that if you see any particular stock which is sideways for the for at least for few days or few weeks, then we can use this strategy. And we should not make this strategy on the day of expiry or close to the expiry, because it may possible if you make this strategy on the day of expiry. On the day of expiry, we have very volatile market session. So in that case, you have to bear some kind of loss. But in the beginning of the expiry or in the middle of the expiry, if you choose this strategy, then we can make some good profit. So if the market will remain volatile, you could make the benefit of time decay, because in the call writing, when you write the call, the theta will work against you. Oh, theta will work in your favor. It is work against the call buyer. Okay. So as the time passes, according to the time passes, according and the market will remain volatile, then with the help of the time decay or with the help of theta, your premium will decay on the daily basis. And if the market will remain at the same level on the day of expiry or close to the expiry, you can retain all the premium you have received in the earlier. So I'm going to give you one live example. Okay. Now I'm going to Excel. Okay. And I'm choosing short and straddle example. So I'm coming to NSC. Okay. And I'm looking for a stock which is not much volatile. Okay. So Nifty heat map, I'm going to choose this heat map. Okay. So we can make this strategy on positional basis, because on the stock we have the monthly expiry. But if you want to try on intraday as well, so we have to choose the stock which has the least movement, like any of the stock which has not increased more than. You can choose Axis Bank or India. Okay, so let's try with Adani Port. Okay, so Adani Port. So Adani Port is only 50 paisa down. Okay, so it is not much volatile today, and the open price was 1784. High is 187, 1785. Low is 1752. Okay, so now coming to the option chain, Adani Port. Okay. Now what we have to do is we have to choose any strike price. Like we can choose either this or this. We can choose this strike price 760, 1760. Okay, 1760 strike price. This is my strike price. Okay, and call option and the put option. I need to sell, call, writing, or sell, and also selling the put of the same strike price. Okay. So if you purchase this today in the morning, 760, the value was, open price was, okay. The open price was 24 rupees 5 paisa. We can make it 24. Okay. And the last price was 50 to almost 50. Okay. So 25 was the open price and the closing price was 15. In this case, you can see the stock remain in this particular area, and we have seen according to the time decay, with the help of time decay or theta value decrease, and the premium become 15 from 25. So we can make 10 point profit in the call selling. Now coming to the put. Okay, the put price was 6 rupees 80 paise and it is closed at 5. Okay, so 6.80 was the opening price. The closing price is 5. Okay, 5. The difference is almost 1.8 point. So we can make it 2 and we can make it 7. Okay. So here you can see the put price is also decreased. It become 5 from 7. So we can make a profit of 2 point here as well. 10 plus 2 equal to 12. We can make 12 point profit. And the lot size of Adani Enterprises is Adani Port, sorry. 475. So 475 is the lot size. Okay. 475 multiplied by 12 is your profit. You can make 5700. Okay. Now, if you analyze that chart as well, this is Adani. Adani. Okay. You can see this is the today's session. Okay. So market opened at this level. Okay. Came down up to this level and again close at this level. Okay. So market goes down, but before the market close, it will recover and close near to the, only there is a very much difference in the opening and the closing price. If you observe the daily candle, okay, you can see this is the open price and this is the closing price. Okay, it opened at 1784 and closed at 1752. Okay, so in this way you can make a profit up to 5700 if you do the call writing. Okay, so same thing can be applied on any particular stock. Okay, now if you analyze and see the total premium you have received for this is 25 plus 7 equal to 32 point. Okay, so maximum profit would be 32 point if you hold this stock till expiry and the price close at this level. Okay, but if the market go below this strike price or above this strike price, then you have to bear some kind of loss. Okay, so what would be the payoff? Okay, so first of all, your break even point would be, break even point for the upper side would be 1760 plus 30. 1760 plus combined premium equal to this one plus this one equal to this 1790. Okay, this is my upper side break even point. Same thing, break even point on the lower side would be 1760 again minus 32 point equal to, okay. So if the market remain in this region, we can make some profit. If the market is going above or below this level, we will have to bear some kind of loss. Okay. So now I can make some profit and loss table. Okay. So if the market is 1800, 1790, 1780, 1770, 760, 1750, 1740, 1730, 1720, 1710, or 17. Okay. So if the market is here, okay, and we have choose a strike price of 760. 760 is my strike price. Okay. This is my strike price. Okay. And up to 32 point, okay, is my break even. So 60 plus 2 equal to 92. 1792 is my break even point. Okay. So this is my break even point. And on the lower side, this is my break even point. So if the market remain in this area, okay, then we can make at least some profit. And if the market cross this area, then we have to bear unlimited loss. So this would be my break even point. Okay, this is my break even point, and this is my break even point. Okay. Now, if the market come up to this area, okay, 790, okay, the intrinsic value would be 30 point. Okay, intrinsic value would be 30 point, but we have received the premium of this 32 point. So still we make a profit of 2 point. Same thing here, it would be 2 point profit. If the market come up to this area, okay, the loss would be 20 point, but we have received the premium of 32 point. 32 minus 20 equal to 12 point. Again, there is a profit of 22 point. Here is a profit of 22 point. And here would be the profit of complete 32 point. Okay. After this level, okay. So at this particular time, the intrinsic value would be 40 point, but we have received the premium of 32 point. The 40 minus 32 equal to 8. There would be the loss of 8 point here. Same here. It would be a loss of 8 point. And if you go above, then here would be the loss of 18 point. Here would be the loss of 28 point, and so on. If the market go below this area, you have to bear. Same way, if the market cross above this level, again you have to bear the loss of 18 point. Okay, because difference between this or this strike price is the 50 point, and we have received the premium of 32 point, so it will protect you only up to 32 point. So 50 minus 50 minus 32. Okay, so 50 minus 32 equal to 18 point. There would be the loss. Okay. Here minus 40 plus 32 equal to 8 point. Here 30. Yeah, 30 is also there would be the loss of 32 point, but where you see the premium of 32 point, there would be profit of 2 point. Okay. Here would be the loss of 20 point, but we have received the premium of 32 point. That's why that will be the profit. Okay. So at this strike price, you will get the maximum profit of 32 point. But total premium we have received. Okay. If the market close at this level, okay, so there would be the loss of 10 point, but we have received the premium of 32 point. So we will pay 10 point from this 32 point, and still we have the profit of 22 point. Okay. Here would be the loss of 20 point, but we have received the premium of 32 point. 32 minus 20 equal to 12. Still we are in a profit of 12 point. Here we are in a profit of 2 point. Here we are no profit or no loss level. After that, the loss would be 40 point. I received the premium of 32 point. The total loss would be only 8 point multiplied by the lot size. Same thing for this scenario as well. Okay. So here we have the loss of 10 point, but we have received the premium of 32 point. So still we are in a profit of 22. Here would be the loss of 20 point. Here would be the loss of 30 point, but we have received the premium of 32. Okay. And there would be the 32 point loss with the 32 point profit. So it would be 0. Okay. Same therefore, this is your break-even point. Now here the loss would be 40 point, and we have received the premium of 32 point. So 40 minus 32 equal to minus 8. Here would be the loss of minus 50 point, and we have received the premium of 32. Okay. So the loss would be 18 point. Here would be the loss of 60 point, and we have received the premium of 32. So it will only protect you up to 32 point. So whatever the intrinsic value, if you minus this 32, the combined premium from this, so total loss would be like this. And it can be unlimited if the market become volatile and move in one direction, then you have to bear unlimited loss. So what we have to do is that if you see that market is not going to in your favor, you can always place a stop loss and make a safe exit from the uh, trade. Okay. So you can see if the market is going up to this level or this level, so we can exit at this point, we can exit at this point, we can exit at this point as well. Okay. So if you exit on this point, still you will make some kind of profit. Okay. So if you analyze any particular stock which is in the range bound for the few days, okay, so you can see in the entire month of July or in the entire month of June as well, the stock was not much volatile. It was around in this region. Entire May or June after the 15th May, and so it was in this particular range, or even in the June as well. It has not crossed this particular range. Okay. So if you see the same thing that's in the option contract, okay, I'm going to option contract and click this same thing and choosing the same strike price of call option. Okay. So if you make the same strategy on the starting of this month, on the 1st or 3rd of July, the initial value was 145 point. Okay. And you can see in the entire month, due to the time decay, the value has come up to this point, 18 point. So if you made this strategy in the starting of this month, you could have made this much profit, 130 point. Okay, so this is due to the time decay. Same thing if you apply for the put as well. If you see the data of put as well, so again I'm going to choose, and this time choosing the put. Okay, now again on the 3rd of July, we have seen on the 3rd of July. Okay, the value was 7 rupees. That it increased up to 38 point, and now again it is around at the same level. So you can see it if you have made this strategy. Okay, the put value was starting of the month, it was around 12, and if you see on the same date, 1st July, the value was around 17 rupees. Okay, and on the day of close to the expiry, we have seen it is close to the 5, and yesterday it was around 3 rupees or 5 rupees. Okay. So in the entire month, you have seen the price of this strike price is coming downward direction. So this is just due to the time decay or theta decay. Okay. So in this way, you can make this strategy. First of all, you have to select the stock which are in the range bound region, which are not uh, much volatile. You have to choose these kind of stock, and after that, if you see that stock will remain in a particular region, you can do the call writing and the put writing. And in the starting of the month, the premium is also very high. If you see the same stock, the same strike price for the next month, okay, you'll see the uh, premium is 45 point, and same thing for the call. You see the premium is right now 66 point. So 66 point along with 45 point, 66 plus 45 equal to 111 point. Okay, so if you buy a call option or the put option, so 7600 plus the break even point would be this one plus this one equal to this one. Same way on the lower side, this one minus this one. So if the stock will remain in this region, we have a more than 100 point range. If the market is not 100 point, if the stock doesn't move more than 100 point in any direction, okay. So if you buy the same strategy for the next month, but today as well, and if the market will remain in this region, then you can make a profit up to 111 point. Okay, if the market is going to break either side, then you have to bear the loss. But still we have more than 1 month time, so sometime it may happen the market will go upward direction, and again stock price will come down and become up and down again, and on the day of expiry it come up to the same level. So if you see on the chart 1870 and 1649 both level, coming back to the normal chart. Okay, so 1879 you can see this would be the, this is one of my order block at this region. Okay, and 780 is around this. Okay, so it has to cover a long area. Okay, there is a huge difference between this price and again this price. Okay, okay, so if the market remain at this level, okay, then you can make very good profit. Okay, the market is around this level, and there is a very much more than 100 point gap here as well, and more than 70-80 point gap here as well. Okay, So if the market is not going to break either side, then you can make some good profit. So that's it for today. Then we'll continue with the next class with another strategy.